In this video, we'll be going over the letter of intent as it's known in most places. In the UK, it's called heads of terms, also known as HOTS. Now, the letter of intent is when you have agreed the basis of the deal with the business seller. So you're going to do an acquisition, you've negotiated, you made offers. Now that's all come to an end. You're going to put whatever has been agreed between the two parties, between buy side and sell side, and you're going to put it into this document. Now there's a few things that you need to understand with the letter of intent is that number one, it's not legally binding. So the deal structure is not legally binding. Deal structure, not, I'm going to underline this, legally binding. So you might be thinking, hold on a second, you've gone through back and forth emails, phone calls, meetings, maybe even in-person meetings, and you've done all of this negotiation, and at the end of the day we're going to put all of that into a document, and that structure is not going to be legally binding. That's correct, because the letter of intent is the intention of the buyer to buy a business or the business with this structure. But it doesn't mean that they are going to do that. It's not the actual final agreement itself. It's the first step of the agreement. And that's why it's so important to understand that you can put whatever you want in this document. Of course, it needs to be negotiated in good faith, but you can put whatever you want in the document, but it might end up being something else by the time you actually complete the deal. So if, for example, the deal structure is not legally binding, then what is the point of this letter of intent? What is the point of the heads of terms? It's to lay out the foundations and the basis. Now, 9 times out of 10, if you've done a good job as a business buyer and the seller has been forthcoming and provided all the information that you've requested for them, then the deal or the formation of the deal structure as is in the letter of intent or the heads of terms will be almost the same, if not the same, when you come to down to the agreement. But there are 2 things in the letter of intent or the heads of terms which are legally binding, and that's number 1, the exclusivity period. Now this is really important. Exclusivity. That is legally binding, and this is legally binding on the seller, of course the buyer as well, but the seller, this is more on the seller. So it's exclusivity by the seller that they are not going to talk to any other potential acquirers. They're only going to talk to you. They're only going to disclose information to you. So that is the number 1 thing which is exclusively or legally binding upon the seller, that they can't talk to anyone else. And this is really good because it gives you the opportunity to go full in, do all of the investigation that you need, the due diligence, to be able to see, is this business as is being sold. So this gives you exclusive rights to the business as well. The next thing is the non-disclosure. So non-disclosure, and this is for both the buyer and the seller. So where the exclusivity is on the seller, the non-disclosure is on the buyer and the seller as well, because you will probably be disclosing some information as a buyer to the seller, some things, and the seller is not allowed to tell anyone what you're disclosing to them, and vice versa. You're not allowed to disclose to anyone what the seller is telling you, because now you're going to be unpacking the business. You're going to be looking at the customers, you're going to be looking at the staff, you're going to be looking at the contracts, legal terms, financial terms. You're going to be looking at everything during this due diligence period. So the seller needs to be comfortable that you're not going to be selling or trading or exposing these secrets, making them public. Of course, it's not in your best interest to do that as a business buyer as well, because of course if you complete on the deal, then all of a sudden you've got this situation where things are out in the public. So these are the 2 things which are legally binding in the letter of intent and heads of terms. Now let's get into what you're going to be putting in the letter of intent in the heads of terms with regards to the deal structure. So the first part of the heads of terms or letter of intent is that who is buying who. So who is buying who. So it could be X legal entity is buying or acquiring Y legal entity. So now it's very clear that who is buying who, meaning the acquirer is going to buy Y business, which is the target acquisition. Now this is really important because, now actually let's backtrack, let's rewind a little bit. Normally when it comes down to the letter of intent, I don't want to get the lawyers involved at this point. Now I already have a document which we use, so we have an indication of interest document, we have a letter of intent document already prepared. We have templates of it that we use with all of our acquirers. My clients use that. I give that to them. They use that with their businesses that they want to acquire as well. So this is the formation. The reason why you want to keep lawyers out of it is just to keep costs down. Simple as. There's no other reason. And because it's not legally binding wherever this document, other than the exclusivity and the non-disclosure, actually it doesn't even matter that much with regards to everything else which is in this document. So I want to keep lawyers out of it at this point, to keep costs down and to keep this document flexible and open. Actually, this is also really important, is that from a buy side perspective, apart from a few details which we'll go over now, you want to keep this document as open as possible. So buy side, keep it flexible. Let's use that word, flexible. Now the buy side keeping it flexible just gives you the flexibility to ensure that you can get the deal done in the best way for yourself. You don't want to get bogged down into, for example, the indemnities and the reps and the warranties and the baskets and all of these different things that end up going into the SPA or the APA at this stage. Keep it open, keep it flexible, just to take the deal to the next step. Remember, your job as a business acquirer, as a person who's driving this thing, is to keep the deal moving forward towards completion. And this letter of intent takes that one step further. So keep it as flexible and as open as possible. Now with regards to the formation of the deal itself, the first thing that's going to go into there after who's buying who is the headline price. Headline price or value of the business. So we're going to keep the numbers really easy. Let's say, for example, the price of the business is 2 million pounds. Right, so X acquirer is going to buy Y business for £2 million. The purchase price is £2 million. Then you're going to break it down. For example, just keep it really simple. 1 million to be paid cash on completion. And then, for example, 1 million to be paid, I'm going to keep it simple here, deferred consideration. Now, I've got another video when we're talking about how to structure a deal with regards to the difference between deferred consideration and earnout. Go and watch that video if you don't know the difference. But here we're using the deferred consideration because it's just going to be easier to lay out those terms. And then, for example, 1 million cash on completion, really easy. It will be paid on completion. Of course, these are not the exact words, the sentences that you're going to be using. There'll be other sentences that you put into those documents. Deferred consideration will be like, right, we're going to pay 200,000 on each anniversary for 5 years. Just trying to keep it as simple as possible, yeah? For 5 years. So it's really easy to understand. The seller is going to get 1 million on their completion. Then you're going to pay 200,000, 1 million pounds deferred consideration. And the breakdown of that 1 million pounds is going to be 200,000 each year for the next 5 years to make up £1 million. There's no earn-out triggers, there's nothing, there's no targets that need to be hit in this one. Just really simple and straightforward. Now, that's easy to understand. What else do you need to put in it? If, for example, there's something to do with property, then you need to put the property details in. So, property details. Another really important, now this is so important for you from buy side perspective. From buy side, you need to put in let's just get rid of this here. You need to define the assets. Define the assets. One of the things that you see new business acquirers, they miss out is this part here. Defining the assets, meaning what's going to be the balance sheet, right? So defining the assets means actually defining the balance sheet, which is probably more accurate. You want to define the balance sheet on completion. So what working capital, which is Always an upward battle. What working capital is going to be left in completion? What stocks are going to be left on completion? And are there any assets? Now, of course, when you're buying a business, generally speaking, you're buying all of the assets. You're buying all of the assets. And if the seller wants to exclude any assets, that might have come up through negotiation. It might come up now. Because actually the buyer needs to draft this document. This is the other thing. Buyer needs to draft. This is not 100% actually correct, but although it says a letter of intent, the buyer is intending to buy the business, of course. The seller can draft this document, but whoever does the first draft forms the basis of the document and therefore has a stronger hand in the rest of the negotiation of this document. Remember, everything's a negotiation. You've negotiated purchase price and terms and structure up until this point. Now you're negotiating what goes into the heads of terms and the letter of intent. So buyer needs to draft this document, and that's why if you have the working capital and the stocks and exclusions to assets. Exclusions to assets. So for example, I remember I was talking to a business owner, and we didn't actually end up buying this business. It fell off at the heads of terms stage. Is that I think there was a Porsche in the, it was all electric Porsche. So currently in the UK, it's if you buy an electric vehicle, then you get significant discount on the taxation, and there's very, very small benefits in kind when you are, using your Porsche for personal use as well. So they had a Porsche in the business, and that Porsche, he said, that is going to be excluded from the deal. That was perfectly fine with us. So exclusion to the asset. So working capital. This is probably the most important, right? Then stocks, then exclusion to assets. Okay. The AR. So accounts receivable. What is going to be the accounts receivable on completion? Now normally, and also for example, this is important, that are you going to use completion accounts, or lockbox? I like using locked box accounts. The reason why I like using lockbox accounts, now if you don't know what this is or if you don't know what these are basically the financial mechanisms that are going to be used to assess the balance sheet on completion. Now I know it sounds technical, but you need to be able to understand this if you're going to do, or maybe not you don't need to understand this, your accountant needs to be able to understand this. But it does have a knock-on effect on to operations as well, because with regards to completion accounts, what's happening is that both buyer and seller, they're putting a hard deadline on completion date. With lockbox, what is happening is that there's a hard deadline prior to completion, which actually makes it easy for operations. That's what I found anyway. So lockbox is really easy. Now the only thing that sometimes sellers don't like lockbox is because depending on when the date of the lockbox is that it puts a little bit of restriction on the seller in terms of what they can take out of the business. And to be perfectly honest, when you get to this stage of heads of terms and letter of intent, the seller is basically a custodian to, as long as it gets to completion, to your business, right? Because they're saying, right, we are selling this business to you. We are going to sell this business to you. Let's say we're going to sell this business to you in 90 days or something like that. Oh, that's an important point which we'll get back to. We're selling the business to you in 90 days. Essentially, after 3 months, this business is going to be yours, right? So we're not going to do anything crazy with this business. There shouldn't be anyway, right? That's the other thing. In the heads of terms, actually, it's really important that it's put that the seller won't do anything, and this is actually one of the terms that you want to put in the heads of terms, is that the seller will not asset strip. Put it in asset strip. What does that mean? So for example, let's say there are normally accounts receivable of, let's say, 600,000, which are on a rolling basis, right, for the customers. And it holds, for example, 300,000 in hard assets. The seller's not going to get 200,000 of the 300,000 assets and just sell it to the highest bidder before the sale of the business. They're not going to collect all of those 600,000 invoices prior to completion, earlier than they're normally supposed to be done, pocket it and then run away with the cash. Because that's not how the normal course of business is. So you want to basically put in there that the seller is restricted to take cash out of the business, to take payments out of the business which are not normal course of business. And that's why we like to put a lockbox mechanism in there, because it actually stops the seller from taking anything out of the business without prior agreement with you, the buyer. Remember, this is a buy side video, so we're trying to do things from the perspective of a buyer. So you're putting that restriction on them to protect the assets and the cash in the business. And of course, come completion date, then you can agree what can be paid out to the seller based on the time period that the seller's been managing the business for you. So that needs to go in there. So completion accounts or lockbox. That all came out of the accounts receivable. So how much accounts receivable is going to be left in the business, or what's the normal course of business? Some of that, for example, can be taken out. So there may be accounts receivable which are from like 120 days ago. So you could agree with the seller, is that right? Anything from 120 days to 91 days, not 90 days. For example, 90, or actually keep it 90 days, is the seller. So anything from 1 to 89 days is for the buyer, meaning for you. Right, that's just an example. Now, no business should really have an accounts receivable payables time of 89 days. It should be 30 days or less. But we've seen cases where actually the AR is as long as 4 months, which is crazy. I don't know how they operate the businesses like that. But that's just a really bad example. So, or an example which is bad from a business perspective. So you want to put all of that in the letter of intent and the heads of terms. And finally, you just want to make sure, now this is the other thing that we were saying, is that with regards to the exclusivity period, you need to have an exclusivity period. The seller is not going to agree to have an exclusivity period, an unlimited exclusivity period. We like to get 90 days. At least, meaning at least 90 days. At least 90 days. Sometimes we've got away with 120 days, which is 4 months. So 90 days is 3 months, 120 days is 4 months. I think the longest we actually got away with was 6 months. But we didn't actually complete on that deal because we had I think 2 transactions prior to this transaction. So we said to the seller that you have to wait 6 months because we're going to complete on this deal, then we're going to complete on that deal, then we're going to complete on your deal, right? And then the seller ended up pulling out at the end of it because they said we don't want to sell the business right now. Whatever, 6 months is a long time, they can change their mind, right? So you would have at least 90 days to 120 days of exclusivity. Now, I have seen this go down as low as 30 days. I've never seen it to be 30 days, me personally. I've heard of people agree to 30 days. In fact, in large transactions, you've heard as low as 14 days, but that's crazy. I don't even know how that works. Like, in any practical way, how you're supposed to only have 14 days to do due diligence, right? It's just beyond me. So these are the things that you need to put into the heads of terms. The main thing, working capital and assets. Working capital and assets. Because if, for example, there's not enough cash left in the business, you can end up... I made this mistake on my first deal. The mistake I made is that we didn't define how much working capital is going to be in the business on completion. So therefore, the seller actually stripped the business of cash. They stripped the business of cash, so there was zero cash. Now, it wasn't a negative balance, nor it was a positive balance. It was exactly £0. But what ended up happening is that we had to save up money from the income of the business. I can't remember exactly how long it was. Let's just say it's a month, for argument's sake. We had to save up money in the business for a month before I was able to take anything out, or we were able to pay anyone who was part of the deal, meaning the lawyers and the accountants. And lucky we had a good relationship with our lawyers, good relationship with our accountants, and obviously you have to wait to pay yourself as well when you're able to. But we got that cash balance up in the business, and then we were able to do what we needed to do in terms of taking money out for ourselves. So that was really a learning curve, and learning curve on our first business. That could have been disastrous. If the business is a capital intensive, now business is not capital intensive business. If a business is a capital intensive business and you don't have your working capital in there, then that's, you're asking for insolvency on day one. Now, how much working capital? Of course, you should try to get as much working capital as possible for yourself for completion. Ideally, you want about 1 month of operating expenses at the very least, right? So 1 month operating expenses. Plus money for, just move this out of the way, plus money for tax. So of course a business, it accrues taxation as it goes along. So in the UK we've got VAT and corporation tax. In the US you'll have sales tax and corporation tax. So you want 1 month's worth of operating expenses plus the tax which is associated, plus wages. If for example there's any wage accruals, because these are your big expenses. Right now, obviously wages goes into operating expenses, but sometimes if you define them separately, you might be able to get a little bit more cash out of it. So these are really important factors when you're looking at the working capital. Now, if you can get 1 month of revenue, that's even better. 1 month revenue. Keep it rev. If you can get 1 month worth of revenue as the working capital, that's even better. And of course, if you can get more than 1 month for any of these things. Now, for example, in the example where people were waiting 60 days, 90 days for their invoices to be paid, you need to have working capital for that same period of time. Actually, let's put that in there. If you have accounts receivable, yeah, let's say for example, you need the working capital, that's cash by the way, to cover business expenses till you get paid, meaning your business gets paid. So you have to look at what's the normal time in which these invoices are fulfilled. Then you have to ensure that you've got enough working capital to run the business until those invoices are paid. So if it's like 30 days, 1 month of working capital. If it's 60 days, then you need 60 days of working capital. If it's 90 days, you need 90 days of working capital. So it's really, really important that you understand how much working capital is in there. Actually, when it comes down to the assets and defining them, you should also ensure that you've got enough current and total assets. Total assets to cover liabilities. And these should be verifiable. Verifiable. This is in fact one of the sentences that we have in our standard heads of terms. So in our standard heads of terms, I can't remember the exact sentence, something like, there's enough verifiable something or the other, current and total assets to cover all liabilities. Actually, no, the sentence that we have is that we have enough verifiable current assets to cover total liabilities. That's what we have. That's exactly the sentence that we have. So enough verifiable, that's not the exact sentence, but that's the basis of the sentence. Enough verifiable current assets to cover total liabilities. Now we're getting an accounting lesson here. What's the difference between current assets versus total liabilities? Current assets means is that you've got assets right now available to you now. When I say now, I mean like within this year. So current assets normally means within the year. So you've got current assets available right now, whether it's cash, working capital, other assets to cover all liabilities that you have. So what's total liabilities? Total liabilities are any liabilities that may be outstanding after a year. The best way to explain this is that if you have the cash and stocks, let's say these two examples. So you've got cash and stocks and accounts receivable, 3. Cash, stocks and accounts receivable, enough of that to cover all of your liabilities to pay your suppliers, your wages, your tax, your everything. Plus, let's say, for example, there's a bank loan in there, right? There's a bank loan which is over 5 years. Then that cash and those stocks and those accounts receivable should be enough to cover the debt of that bank loan too, right? So that's really important. So that's the sentence that we have in our document. Is there anything else that needs to be covered in there? So total assets over current assets over total liabilities. I think that's about it, to be perfectly honest. So when it comes down to your heads of terms, and again, every business is different. You're doing all this negotiating. The circumstances of all businesses are slightly different, and you need to understand what the nuances of that business that you're looking at is, the nuances of your industry, right? So all of these things play a part as to what's going to go into the heads of terms with regards to ensuring that you've got a healthy business on completion. So that's it for this video. If you want to find out more about acquisitions and increasing enterprise value and exits, then continue watching videos on this channel, and I'll see you in the next video.